Okay, so for the first time in, well, what feels like forever, the world's financial attention isn't locked on Washington.
Right. Or Beijing.
Exactly. It is laser-focused squarely on Tokyo. And the stakes here are just immense.
They really are. We're seeing the Japanese yen, after years of just falling and falling, suddenly strengthening.
And it's threatening to snap this 50-year streak of stability for the U.S. dollar index. I mean, that's a benchmark that hasn't really wavered since the 70s. We've gone through all the source material on this. We're going to try to cut through the noise and figure out what the key factors are driving this massive, massive shift in currencies right now.
To really get it, you have to look back just a few weeks. The yen started its latest big plunge in early October.
Right after PM Saita Kaiichi won the leadership race.
Exactly. And she's a well-known follower of Shinzo Abe's playbook, keep rates low, pour in the stimulus, and just push for export growth.
So the markets were completely braced for more weakness, but then it all just flipped.
It really did.
Takaichi's chief economist hinted that maybe the administration could tolerate a tiny rate hike, just 25 basis points from the Bank of Japan.
And while 25 points sounds like almost nothing, after years of basically zero interest rates, it's a huge psychological signal.
A signal that traders are now betting could come at that big BOJ meeting on December 18th.
And the yen's reaction was immediate. I mean, just 2 weeks ago, it hit a crazy low of 157 against the dollar.
Unbelievable.
Then the momentum just reversed. It climbed sharply to 154, gaining over 2% in less than 2 days.
And look, 154 is still a long way from its historic norm, which is, what, around 110?
Oh, for sure. But any upward move like this is huge. It shows the market is already pricing in that rate hike.
So let's talk about what this means inside Japan. They seem to be in a really tough spot.
A very unusual bind, yeah.
A weak yen is great for their exporters, right? That's the backbone of their whole economy. But on the other side...
On the other side, all the imports priced in U.S. dollars, especially oil and energy, become painfully expensive.
Which is driving up their domestic inflation, which is now running around 3%.
Yeah.
So what is the BOJ doing to fight back?
Well, that is the core contradiction here. The BOJ governor, Kazuo Ueda, is hinting at raising rates, maybe from 0.5% up to 0.75%, to stabilize prices.
Okay, a small tap on the brakes.
But at the exact same time, PM Takaichi just rolled out a massive stimulus plan. We're talking 2.3 trillion yen.
Which is what, about 135 billion US dollars?
Yeah, and it includes things like cash to help people pay their energy bills, payments for children. It's like the government is flooring the gas pedal while the BOJ is just lightly tapping the brake.
Wait, but how does that make any sense? How can you treat a country with confidence when it needs $135 billion in emergency stimulus just to pay its energy bill?
I know. This mix should create a ton of uncertainty.
Yet investors are seeing this potential rate hike as a sign of confidence.
That's the key insight. The market sees any move away from zero interest rates as a sign of sort of economic maturity, a return to normal.
I see. So that normalization signal is more powerful than the short-term debt concerns.
That is the core bullish bet on the yen right now. Investors are saying, yes, Japan can handle higher rates, even with its insane debt-to-GDP ratio.
And if we widen the lens a bit, this isn't just about Tokyo, is it?
Not at all. A big part of the yen's strength is actually U.S. dollar weakness,
The U.S. dollar index just had its 11th straight day of decline.
which is its longest losing streak since 1971.
1971, the year Nixon ended the gold standard. That just puts it in perspective.
It shows how rare this moment is. The dollar's decline is driven by this growing belief that the Fed is done hiking rates, that the U.S. is heading for a soft landing.
So as fear of a U.S. recession fades, global investors are moving away from the dollar as a safe haven asset.
Exactly, which adds momentum to currencies like the yen. But the BOJ is walking a real tightrope here. Raise rates too fast and they could slide back into stagnation.
But if they wait too long, the yen could collapse again, and that would just fuel more inflation. So connecting all the dots, it seems like everyone is just holding their breath for the Bank of Japan's December meeting.
Absolutely. Their decision isn't just about the yen. It's going to send ripples through global bond, stock, and currency markets everywhere.
So Tokyo's trajectory right now is, in a way, everyone's trajectory. That ripple effect is what you need to keep watching. The next few days in Tokyo could have real consequences for your energy bill, your investments, and, the stability of the entire global economy. If you enjoyed the video, you should subscribe to the channel, turn on the notifications bell, leave your like, and share the video because it helps us keep the channel going. Thank you.